You're listening to the Perth Property Show, Australia's only weekly property podcast by West Australian experts for West Australian listeners. Catch your latest episode every Monday at 7 a.m.
Good morning, everyone. Welcome to the Perth Property Show. My name's Trent Fleskens, your host as always. What a beautiful April we've had over the last couple of weeks, and an interesting time in the Perth property market given all the noise around the world in the state elections, tariffs, all the junk none of us want to be listening to or talking about. But it is a part of our world, a part of our risk profile, our opportunities. Where there is chaos, there is always opportunity, and there is opportunity in the Perth property market. For us to discuss with my main man, Brendon Ptolomey, Managing Director of Herron, Todd. Brendo, thanks for coming in, mate.
Hey, Trent. Thanks for having me, mate. Bit of chaos out there at the moment.
Last time you were in, it was start of the year.
Yeah, January.
Yeah, we were looking forward to the elections. We knew they were coming up.
Yep. We
didn't really think tariffs were going to be a part of the next conversation, though. And I guess we'd probably hoped we'd just be cracking on with interest rate drops as well and discussing our ability as an industry to supply housing to an ever-growing population. Just ticked over the 3 million people mark.
Yeah, crazy numbers.
Last year. So a lot of interesting investment factors that are hitting industries around the world, hitting markets around the world. The share market's obviously in turmoil over the last couple of weeks. I think it's important for us to break down for everyone what that means for our little property market here in Perth. Not the global property market, not the Australian property market, not the Australian share market, but our property market here in Perth.
Yeah, Trent, it's a pretty concerning week or two. In particular, the headlines are out there around what's happened to people's wealth, their superannuation placement, obviously the stock market, 7 to 10% drops on stocks that are relatively solid in terms of long-term holds for lots of people. So probably what drops out of this in terms of where our property market ends up is how hard this hits consumer confidence. So does everyone put the queue back in the rack? Do they stop spending money? If they were shopping for a house in the Perth suburbs last weekend, be it first home buyer, downsizer, upgrade buyer, do they put the queue in the rack and say, that's over? I'm really unsure about what happens here. The big orange guy's making some crazy decisions there in Washington, and I just don't know how that affects the Perth market, so I better just stop what I'm doing and not spend any money.
Or is it slightly irrelevant? And that's what we want to talk about today. I don't want to come into this conversation with a preconceived idea. I want us to sleuth it out if we can. But what I will do is provide my first points, and those are that we know that markets in America have lost more value than they've ever lost before, even with the GFC, for example.
Yeah.
And it's interesting to note that's happened whilst not feeling like a crash in a way. It hasn't felt like it's reverberated around the globe in the same way that it did in 2008. I remember 2008 watching the TV and it was this 9/11 moment. Oh my God, the world's just stopped.
Yes.
It doesn't feel like that. It just feels like all the houses are on fire, but everyone's still living in them and complaining about it, but everyone's just getting on with it.
Yeah.
It feels like a reset nearly, and something that Trump's looking to do is create so much volatility and see who comes out. Where there is chaos, there is opportunity. But that markets are still running, shops are still open, people are still buying things, people are still going on holidays, there's no pandemic, the bank hasn't just closed. Do you know what I'm coming at here? It just feels like a lot of noise and a lot of people complaining about losing money on the stock market in America. And to be fair, every stock market around the world has had huge losses in blue chip shares especially. But I'm still trying to sleuth in my head, how does that impact Perth's property market, where the dynamics of demand and supply are based on how many people moved here, how many people need a roof over their head, regardless of what the share price of Apple is this week, or Tesla.
Nvidia
or BHP.
Yep.
And how many houses we've got available right now.
Yeah.
And we will talk through what those numbers look like and have changed or haven't changed since January. Are they fair comments to make? What do you think about it?
Yeah, look, I think it's probably a time to compartmentalise some of this information, in particular what you're referring to there in terms of the overseas stock market, whether you're in Europe or the US. How is that affecting me? And there wouldn't be that many consumers, I would have thought, that would be directly involved in those markets in substantial amounts of money. So fair enough, they might have ETFs and those sorts of investments in their super. But in the past, I think it's worth thinking about what happened with these corrections, and in particular go back to stock market crashes in the late 80s. These were significant corrections where people had, through probably a lack of education back then, large amounts of their capital involved in certain sectors of the market, that when they changed dramatically, they lost huge amounts of money. And then I go back to what's happening now with that news cycle, and that commentary that will be in our daily news cycle around superannuation funds have lost billions of dollars. So for the average consumer, unfortunately, you've lost a bit of money in your superannuation. But let's just remember, like property, superannuation's a long game. It's probably the people that get affected worst here are the people that are going to retire in the months either side of this event. They probably have had a dent on their capital. But again, you invest this money to make a return over a period of time. And I think,
decades.
Yeah, exactly. And I think that those big super funds are now educating us around the concepts of, we're going to make you 5% per annum after tax or pre-tax dollars in your super year on year. Some years that's going to be 10 or 11% like it probably was last year. This year, obviously in this calendar year, it's probably not going to be as high as that. It might be 1 or 2%. But on your averages, you're going to work out over a period of time. So I'm just correlating that back to, how do you then make decisions on the back of these events? How does consumer confidence weigh in? And so what are those other factors that come into that? We just think about the Australian economy maybe first. Some of the press around at the minute is immediately jumping to interest rate corrections or decreases up to 50 basis points. People are calling for the May meeting. Some good commentators, people like Shane Oliver from AMP, is already calling that it's got to be at least a quarter of a point down. Yep, the kook. So those guys are already out there saying we need to reduce interest rates.
They've been saying that for a while though, haven't they?
Yeah, the kook has, but Shane Oliver's probably a little bit more conservative. If he's saying it, I generally think that's going to happen. And the other part of that, obviously, is that we maintain our economic cycle in terms of trying to control inflation. And so then if we think, and I'm not an economist, but if you just think about what will probably happen to consumer prices here. So potentially interest rates going down. It looks like petrol prices will go down, which is a huge cost to all of the Australian consumers. And the other part about it in terms of election is obviously there is a tax cut coming into the future, and probably the more immediate effect is control or rebates on energy prices. Again, probably helping with the cash flow side of things for the average Australian consumer.
But also the average business. All those things you've just mentioned, interest costs, fuel costs, and energy costs are all the things that make our products more expensive.
Yep.
So if those things start coming down, our products, the inflation on the cost of buying stuff out of Woolworths and Coles and all these places that are under the microscope, suddenly it makes it easier for them to go, oh, we're giving you savings, because they're actually getting savings as well.
Yeah, absolutely.
And then you also think about, do we really care if Americans now have to pay a larger tax, a tariff on importing a Volkswagen from Germany?
Yeah,
we don't care about that, but what that might mean is that there's extra stock around the world that isn't getting sold to America anymore, and so those things might actually come in a bit cheaper, dumping in Australia.
Yeah, absolutely.
That could help things be cheaper as well. And it might not just be a car, it might be a washing machine, all these other things that people in China now, with these massive tariffs that build this stuff every day, you can't sell it to Americans anymore because now it's double the price. I guess we got all this extra stuff. We should probably flick it on to the Aussies and the Kiwis and all these other places at a discount. Otherwise, it's not going to get sold at all.
The favourite example I saw was beef exports from Australia to America. They use our beef because it's leaner than theirs. They mix it in with their beef to create McDonald's patties. And, you know, what happens to that? We saw this during the tariffs that China placed on Australia. What will happen to that product is that we'll find another home.
Just gets moved somewhere else.
Yeah, exactly. So we might sell it into Asia or even just consume it ourselves and obviously have cheaper beef prices in Australia.
So isn't it interesting how everyone is getting really scared at the moment about change? People don't like change. They don't like uncertainty. But when you start to sleuth a lot of this stuff, it sounds like things are going to cost less for us. And what we know is when our cost of living goes down for most of the other consumables, our non-negotiables, leaves a bit more money for the thing that we want to be doing, is living in a nicer area. And if the fundamentals remain the same as they have been for years now, and it doesn't look like it's changing much at the moment, we still have 5,000 properties on the market like we did a few months ago. We're still buying 900 to 1,000 properties every single week like we have for 5 years straight now. If interest rates start going down and the cost of other things start going down a bit because we're just the Steve Bradbury of this tariff war, then that sounds like a pretty good mix for more kerosene on the fire on property prices in Perth, doesn't it? As long as people want to live in Perth.
Yeah, potentially. Exactly. A couple of factors to add into that. What we've seen in history that we can look back on is that when there is a correction in the stock market and the equities market, that often the capital comes out of there looking for another home. And so sometimes that is property. It's probably easier to get into things like REITs and that kind of stuff if you're selling out of your stocks.
Or a leased investment.
Yeah, exactly. Or potentially, if you're pulling money out of the stock market, you might actually go back into your principal place of residence in terms of reinvesting that capital to an upgrade buy or something along those lines. So we have seen in the past that capital comes out of the equities market and into property. So there's a positive sign, and there is some history to demonstrate that. The other part about this is about the employment scenario for Western Australia. It's still extremely strong. We still have a large volume of jobs available to skilled people to move to Western Australia. And again, as we've talked about on this pod in the past, that just puts pressure on accommodation full stop, whether that be to buy or rent. It means that demand is held up. If anything, out of this, there's a pretty good argument, and I know we always are on the positive side of things in this podcast, but there's still a pretty good argument to say that with strong employment, Perth as a destination remains really attractive.
What about to those people who will point out to, Rio just laid some people off, MinRes just laid some people off, we're still worried about the iron ore price, even though it seems to be staying where it has for the last 12 months, and saying therefore your employment's going to drop. Where's the employment coming from outside of that?
So it's interesting, there's some stats recently about how many people the mining industry employ, and it is, depending on who you're listening to, it's 110 to 140 odd thousand full-time jobs or FTEs in our marketplace. In the scheme of things, that is not a huge proportion of our population.
Well, there's
now.
3 million of us.
Yes.
Obviously, half of us are kids.
Yeah. And so I get that there's a lot of onflow into, that's direct employment numbers that we're talking about there. And so there's a lot of onflow in terms of service industries and the economy being supported by the inflows. But the underlying thing here is that that industry, or the cash made from that industry, in particular by our state government, feeds into a lot of other projects, a lot of other spending, which therefore washes out in a lot of jobs. So things like construction industry, property industry, finance industry, obviously the health industry on the back of supporting our population, all massive employers in our marketplace.
Well, that's one thing we know about Labor governments, whether you like them or not, is they like big government, so like employing a lot of people, whether that's efficient or not, and they like lots of construction because it creates labour jobs, creates jobs for unions, so there's work there, so they spend a lot of money, and if they've got the money to spend through royalties and through the GST deal, for example, which continues to be a godsend for this state, then it really seems to be a much bigger industry in a way than the mining industry. And we know that health, education and real estate and construction are actually larger industries as well. So it just seems like it is, people continue to say, oh, we're a diversified state these days, and you go, oh, are we really? We're always talking about mining still.
Yep.
But the amount of money coming out of this Labor government that we've had for 8 years now, and we'll have for 4 years, on the amount of projects that we're doing, and then you add AUKUS into the mix, and the federal money that's going to come into the southwest of our metro area, it doesn't seem like the sort of situation where you go, oh, I reckon we can start taking a foot off the pedal in supply soon. It really looks like a sustained issue we're going to continue to have. If we're celebrating being able to have 20,000 building approvals this year, which is what the Minister for Housing is doing at the moment, and we're still bringing in 60,000 plus people, we're still creating deficits, like Jeremy Cordina said about 6 weeks ago on this podcast, every single year. As long as people have got money to spend what they have to spend on the purchase price, prices just keep rising when you can't solve this problem.
So just to touch on local economy and the churn there in terms of capital and spending and the connection back to employment, I just thought I'd touch on a couple of projects that are already underway, ongoing, and there'd have to be significant shock to the world for these projects to stop. So we're talking about Perth Airport. $5 billion spend. Anyone leaving Perth Central in terms of that airport recently will have noticed that they've started building a multi-storey car park there. They're building a couple of those. They're going to build a hotel there. They're going to extend the terminal for Qantas and also build a whole new runway. That's $5 billion over the next 5 to 10 years. There's a huge amount of jobs. It's a very labour-intensive project. ECU in the city, anyone that's been through the train station recently will have seen that still coming out of the ground. 10,000 students and staff coming in there. And the reason we mention this is number one, construction jobs right now, as that gets built, a complicated building to be constructed. Then following that, it has this massive injection.
It's hospo jobs.
The injection to Perth CBD is huge in terms of job numbers, and the injection into a sector that we haven't, frankly, been very good at in the past, and that's the education sector. So pulling in overseas students into a time zone that we're lined up in, Singapore, Malaysia, China, into Perth. We're building the accommodation at the same time, which is very encouraging. People that want to argue with us about this does not assist the housing crisis. We're currently creating about 1,500 student beds right there in the city centre on top of what we've already got. So they're actually creating the solution to the housing crisis, bed supply crisis that we have in Perth at the moment. And then you mentioned AUKUS, $8 billion spend over the next decade down there. And we know from talking to people like Cathard at REWA that both the US and UK Defence Forces are out looking for a home for hundreds of staff that are coming into Perth and, in fact, coming into other regional locations like Exmouth on the basis of a defence industry as well. And then the other side of things is just from a construction point of view, if we have anyone released from those Metronet projects and the smarter freeways type projects, they will immediately be sucked into the residential side of things, whether it be single residential infrastructure build for residential or built form as in apartment development for residential as well. So we're pretty solid in terms of the provision of employment into the future.
We know what our lifestyle offering is. That's why we all live here. Do we want to look back for a second and see some data that's just come out from Domain, top 20 suburbs for median house price growth in Perth over the last 5 years? The interesting thing, out of those suburbs, nearly all of them, and I'll go through this list, are City of Armadale, City of Gosnells, City of Kwinana, Rockingham. And these are all those areas that have seen massive money pumped into it from East Coast investors over and above price points that most of us could have imagined they would get to.
Yeah.
But I think they're in that top 20 for growth because they're also so undervalued before COVID because of the lack of amenity they offered at the time compared to the rest of Perth. They really got hit the hardest.
Yep.
And with affordability, they've been the easy pickings for investors, but also for first home buyers as everything else has started to get a bit out of reach with interest rates. My concern is that the top 20 suburbs for median house price growth in Perth for the next 5 years won't look like this one because people are going to be able to start to afford, as I've said for the last 4 months, better suburbs with lower interest rates again. So we see people start to slide closer to the city on those train lines. So I'll give you that one right now. Number one is Camillo.
Yes.
Now, I would have said my hand on my heart. Camillo is the lowest socio-demographic suburb in Perth with the worst offerings in terms of amenity. People can call up and say, that's not very nice, Trent. I'm offended. It's the reality, in my opinion. There's very few suburbs that have worse amenity than Camillo. That was at a $220,000 median house price 5 years ago. That's in 163% increase in prices.
163%. Right? That's amazing.
That's Karratha numbers, right?
Yeah.
No surprises. The next one is just Armadale proper.
Yep.
That's in 145, now sitting at 530,000.
Yes.
Cooling Up, which we know is outside of Rockingham.
Yep, just on the edge
sitting at 600 grand now with 135. And then you go down the list, Parmelia, which is in Kwinana, Greenfields, which is in
Bandra. Yep.
Relia, which is in Kwinana, Warnbro, which is Rockingham, Gosnells, Kelmscott, Seville Grove, we all know where they are, Mirrabooka, which is up near Clarkson and was the Armadale of that part of the world.
Yep.
And Port Kennedy, Girraween, Maddington, the first suburb on this list going down from one down that isn't a suburb you would look at and go, I wouldn't probably live there if I had the choice, is North Beach, sitting at 97%, so doubled in the last 5 years from 810,000 to 1.6. And a big reason for that, I think, is somewhat land value increases, but also a lot of people knocking down old state housing stock and building really nice two-storey houses on half blocks.
Yes, yeah.
So the value is just massively house value now. And then you see Balga, Kenwick, and then Callaroo, and then Ellenbrook.
Wow. Yeah, okay.
The end of that list. So probably only in that whole list of 20, only 2 suburbs you would say are aspirational. The rest are low socioeconomic, socio-demographic, at the end of the train line, house and land package, urban fringe. All those words you can say for those suburbs. Not saying they're bad people, not saying they're not places that people aren't happy, just saying if we're looking at it arbitrarily, they're not aspirational suburbs. They're entry-level suburbs or low socioeconomic suburbs. So what does the story look like for the next 5 years, Brendon, where it's probably going to be relatively more affordable next year than it is this year from an interest rate point of view for property? Does that just get cancelled out straight away by price growth? That if it gets 15% more affordable because interest rates have made mortgages 15% cheaper, do you just see 15% price growth to cap that out again on the demand and supply ratio?
Trent, well, there is some good graph data that shows once you make capital more available to people, in particular individual consumers that are buying a house, that they will just spend more, so to speak. That historic data would suggest that values continue to go up. And in particular, you'll just see that reflected in the median house price in Perth. The bit that we probably want to think about here is how did those values go up so quickly? So they're all affordable suburbs originally. The attraction to them for most people was a low price point. And then what we had was East Coast buyer agents coming to look into the Perth market over the last 2 years and realised that if they compared those suburbs that you've just mentioned, pretty much every one of them on the list, they realised they were some of the cheapest real estate in a metropolitan city in Australia. And so
with the highest rental yields.
Exactly. And so then they started looking at the rental side of things, what those yields were doing. We've traditionally had higher yields than most other cities in Australia. Those yields were extremely high, and I would expect that they're still very high. So some of those purchases in there, in terms of those investors that the buyer agents bought in, have done really well. Like, they did their job. They found cheap real estate with a great yield. Some of them will be on 6 to 7% yields, plus have had
plus the growth, right?
Extreme capital growth. So it's a good property investment. Now, what happens next, just if we can pause on those suburbs and whether they can hold their value growth and what happens next in our market, this point in time where we're going through the jitters, so to speak, in terms of world markets and capital, I would expect that the majority of people that bought into those marketplaces are still doing okay on the premise of what they bought in for. So rental return and capital growth, the majority of them will have achieved those two goals through their buyer agent. So now the question becomes, are there any motivators for those investors to wholesalely drop and dump the properties on the market and run away? And again, I would argue with the interest rate profile that we're talking about, their return actually stays the same / gets better. And the only reason that they cash out, which again would be probably a minority in this case of people, is whether they need the money. So retirement age, they want the cash back. Or they're being led
by a Pied Piper to Melbourne for whatever reason they can justify right now.
Yeah, and I would encourage those people to actually take a longer term view of what they hold there. Clearly, if you cash out of an investment property, you do have to pay tax on it and those kinds of things in terms of getting out and getting back in. And I know they'll be thinking, does this crash around me and go back to what the value was? We're really confident that those values don't go back to where they were.
Let's remind people, 5 years ago, the median house price in Ellenbrook was $338,000.
Yes, that's amazing.
You could buy a 4x2 in Ellenbrook for $338,000.
Yep.
Now it's $640,000.
Yep.
You could buy a place in Parmelia for $260,000. Now it's $580,000. You could buy in Maddington for $300,000. Now it's $600,000.
Yeah,
you're
amazing.
Never going to see those prices ever again.
Yep. And so let's just remember that we had a downward cycle in our market for a period of time that created those numbers because we exited a construction boom in the mining industry. I remember the former treasurer saying that 45,000 Kiwis went home from WA. That's just a portion of the construction workforce that left. So the pressure on our employment cycle this time around is not a construction cycle in the mining industry. That has settled down and we're in a production cycle. And then we've just talked about what's underpinning the employment in the West Australian economy and Perth Metro in particular. So
probably the Labor government, mate. At the end of the day, as long as, and I'm not being political about this, I'm just looking at it, Labor governments spend a lot more than Liberal governments. That's the whole point. Liberal governments are about being conservative, spending less, giving more money back, trickle down sort of thing. Labor governments just spend, it creates inflation, but it also creates jobs and hopefully people can, that's just the way that socialism works, right? So as long as we have a Labor government that is continually spending a lot of money, injecting money into this economy, whether they should or they shouldn't be doing it, there's work for those people to be coming in. Now, where's the money coming from? Well, it's going to come from two things, either debt, which they're not really taking it from now because they've got royalties and GST carve up. I guess it comes back to mining again, is as long as the royalties are coming in, Safiotti's building more train lines and more hospitals and all these sort of things.
So probably we should touch on the concept, again, those world events. So for us to be affected, as in the West Australian economy and here in Perth house prices, we would need a severe collapse in Chinese demand for everything we do. And clearly there's some tariff brawls going on between Trump and China. That's going to play out over a longer period of time. What will actually probably end up happening there, though, again, I'm a property valuer, not an economist, but the Chinese have the ability to stimulate their own economy. So if they are starting to suffer, they are people that do not like to lose, similar to Trump, but they will inject cash into their own economy and potentially continue to buy our natural resources to fuel that.
Steve Bradbury effect. That's what I'm calling it.
So what's the name of this podcast?
Yeah, maybe we should. So let's talk about it. What do we think going forward then the top 20 suburbs look like with these impacts? What are the suburbs that start to win out of lower interest rates, continued employment, more people coming in as people are scrambling from where they had to be to where they want to be? Where do people want to be, Brendon, going forward in the next 5 years?
Yeah, I think firstly, it's very difficult to see those dramatic increases over 5 years. That's a long period of time to project out over, and seeing 163% increase.
Let's not expect that. Maybe it's going to be 40% over 5 years.
Yeah, and certainly don't call us and say, where do I make 163% return over 5 years on a property, because we're as lost as you are on that one. Now, in terms of immediate effect, I think we will see a lot of activity in what's now the just above the affordable zone in terms of pricing.
So the next step. Really.
Yeah, and that's below the median house price. You touched on Ellenbrook there. If we look at Baldivis, we're talking about availability in those locations. So they're the locations where we'll see a lot of activity. I don't think we'll see huge amounts of price growth, okay, because there is availability. They're big suburbs. There's a lot of stock available on the market. Where we'll see the dramatic price increases is as we go up, flow up the line in terms of lifestyle opportunities. So you touched on North Beach there. We actually had to have an annual median house price guessing game with amongst the valuers. So for last year,
nerds,
on the metrics that we use, Waterman's Bay won,
yep.
And that was the highest value growth based on median house price for the year. Interestingly, again, North Coast location. Now, the valuers being a little bit cute there in that there aren't that many properties in Waterman's Bay. Small suburb, doesn't take too many high-value transactions to happen, but it does point to what people would like to do next with their money and the age group that have money within Perth Metro at this point in time, and that is people that have paid down debt and created equity through value growth in good suburbs, then they'll go looking for the better suburb, the lifestyle suburb that they've aspired to. And so, again, I would focus on those north coastal opportunities. I think the ones that are undervalued as you go north of North Beach and Triggs to start down to the south there, as you go further up to Hillary's and then again up into places like Aluka and Butler and further up the coast. Similar in terms of character housing close to the Perth CBD. Again, we're going for lifestyle here. Walk out the front door, walk down the road to restaurants, cafes, bars, public transport. And so you would think that those locations such as Mount Hawthorn, round into Mount Lawley and over into Vic Park work, and there is limited supply in those locations.
So we're thinking about all the cool places to hang out.
Yep.
And that makes a lot of sense because that's where people generally want to be living, is as close as possible. I think about the one impact in my life that I try and avoid completely, and that is being stuck in peak hour.
Yep.
So I try and have my house as close as possible to my office, as close as possible to the places I want to have dinner and go out to, as close as possible to my local gym and sports places. Now, that really speaks to starting to retract back into those traditional activity centres that we would go out to as kids but maybe not be able to afford to live at that close. That's where I see most people scrambling to right now, is the Mount Lawleys, the Mount Hawthorns, the North Perths, the West Leadervilles, the Wembleys, the Vic Parks, the South Perths, the Apple Crosses, the Booragoons, places where there is a high street.
Yep.
I think we're going to see a lot of people go, I got an extra $3,000 in equity here. Let's sell and go back to 80-90% loan-to-value ratio at an interest rate that might be 5% or 4.5% by the end of the year.
Yep.
We can afford that. It's the same mortgage payment now. It's just a larger mortgage and we've got more equity that we're using. Let's just upsize on the mortgage, on the debt, on the equity piece, and therefore the lifestyle too.
Yeah. And then the other part that we need to just mention there is that there is no creation of supply happening in those locations. So infill development is extraordinarily expensive and difficult to do.
I know it.
You can, I think some listeners might have heard you talk about that in the past, so I won't get you going on that high horse. Then the other side of things is the larger infill development, so supply of apartments is not happening basically because of the feasibility side of things. So it's not like the locations we just talked about will have a 250 apartment complex jettisoned in there, in particular this year. There's a couple of on the planning block in the next couple of years, but then they've actually got to get a building contract and start building, so they're not coming out of the ground or available to live in for at least another couple of years, right?
And this is what continues to talk to those practical outcomes of what is it that instigates price drops, because it's what people listen to this podcast for. It's, I think, where's the opportunities, but it's also where's the risk.
Yep.
When are we going to know when the risk is? When is there an opportunity for there to be more supply in certain suburbs than there is demand?
Yep.
You've just spoken to it, and we've spoken to it many times before. We don't even have the builders, let alone the developers, to provide this oversupply. So the only way that you have a situation where there is more supply than demand is if the rug gets pulled from demand massively and supply stays constant, and we soak up over the next year or two the excess demand and the undersupply, and then eventually we're at that parity.
Yep.
But everything points to One, I don't know where that rug's getting pulled from in the first place in demand, given all the infrastructure stuff you just spoke about, which creates employment, which creates immigration. And then two, we don't know where supply even gets to a point where it could be the other side around and we're like, geez, there's a lot of apartments coming into this suburb right now. Vic Park is getting flooded with apartments right now. There's no cranes anywhere.
Yeah, no,
the only place there are white cranes are the projects that have been getting built for 4 years now in Applecross, South Perth. That's about it. Where are the rest of the cranes? They're not there because the builders aren't there.
Yeah. So we have a severe undersupply of Tier 1 builders and Tier 2 builders in our marketplace. So literally, we cannot build the projects that are mooted. Some of them have now got approvals. You think about the Blackburns development in City Beach.
Still like
has an approval.
At least 3 or 4 years away from completion.
Same with West Village at Karrinyup, has an approval. It still doesn't have a builder as far as I know. Just talking to the guys at Celsius, Alma Square up in North Perth, I think they've finally got an approval there and still negotiating with a builder to actually start to get that out of the ground.
Trying to get acceptable pricing to actually make it work. I don't actually think the issue is demand right now. I think there's enough people pre-buying or putting down a deposit or putting in a booking for their apartment. That's actually quite encouraging, that there's enough people there to go, oh, we've got enough here for our debt covenants to be able to move. Can we get the build contract to be remotely reasonable that we've got anything left in it to make $1 doing it?
Yes.
And is there a builder who's got the balls to lock in a price? And if you can't get those two things done, you're just spinning your wheels for months and months. Whilst interest payments rack up on the land you're holding.
Yeah, absolutely. And then the other factor there is their pre-sales. So they're getting shy on pre-sales. I know that a couple of those developments that we just mentioned there, that the strategy in terms of sales might be to morph from trying to sell as many as possible off the plan to holding enough back to actually be able to sell once you're completed, so that you can take advantage of the price difference between off the plan and completed units.
And that's really governed by the bank, the financier that the apartment developer uses. Now, most of the time, for everyone listening, if you go through one of the big four, they're going to want you to have 80 to 120% of your debt already pre-bought from pre-sales, right?
Yes.
Which means months and months of selling the idea of something years from now. Or you pay a couple of percent more from a private lender. And if they back your project in, then you just get on with it. And that's two different sides of the risk spectrum, really, as a developer. In a market like this, I know which side I'd be going. I'd be trying to probably just dollar cost average across the whole development. Take some sales now and just keep selling and keep increasing prices along the way until the last one that's done with no risk to the buyer. It's all there. You can see it. You can move in tomorrow and you're paying 30% more than the fellow who booked in 2.5 years ago.
Absolutely.
And that's probably how you pay for the extra interest as well, just to get this thing off the ground.
Exactly. And so we're going to watch that play out over the next month or two, probably right out until the end of the year. Now, the only other thing injecting in that marketplace is the state government, on the back of getting re-elected and John Kerry getting a new old portfolio. We're back to the Department of Housing and Works, and the works side of that is the state government becoming a developer again. Now, they've had Development WA for a long period of time who have focused on regeneration and the supply of infrastructure-led land, i.e. like industrial estates.
And regional kind of places as well, where it doesn't make sense.
A lot of regional supply. They're just trying to make the property market work in some locations.
Plugging the gaps,
And so what they haven't done have ever been developer of, say, built form or apartments. And in this new phase of state government, they are getting back into that supply side. And the reason I raise it is that they're looking to supply about 1,000 apartments over 13 odd sites. So we're not talking about flooding one location. We're talking about a number of sites where they will bring supply of social and affordable housing into the future. And I just wanted to raise it from the idea of there's one other, inverted commas, shock to our market, i.e. they're going to create supply, but they're only very much at the start of that planning phase, and it isn't all going to be in one location.
But it's a good thing for our population. It obviously means more supply, so at some point in time that starts to dampen prices wherever they're going. But as you said, it's years away. It'll be time inefficient from that perspective.
Still got to find a builder.
Got to find a builder, and then the government is obviously taxpayers paying for this stuff that otherwise would not be a profitable development. It's like Common Grounds in East Perth, where you look at that and go, Jesus Christ, man, the money they would have lost on that to house social and affordable housing. No developer is going to develop across the road from Wellington Square in East Perth. But that's the stuff you want the government doing.
They and a good location for it, it's supplying a need. I'll look at, again, back at some of that student accommodation that the private sector is supplying. Can the government maybe get involved in something that design from a social affordable point of view as well?
So I want us to rack our brains for a second, though, on what an actual example historically looks like of the rug being pulled.
Yes.
Now, we've spoken before about the construction market post-mining boom just pulling 50,000 Kiwis out of Perth. We know why that happened, and we know that's different to now. But what about, for example, probably the biggest collapse in Perth's property price that I've been alive for, and that's Mandurah back in the day. That was before the boom.
Yeah, Mandurah got oversold in a previous market where it got hyped in terms of the types of buyer that would come into there. So I'm talking about historic evidence here, and that was boomers coming into the market in terms of buying secondary holiday houses, tourism market, and probably being a little bit too excited about that. The planning of the Mandurah train line, and probably a design that wasn't as good as it could have been in terms of landing the rail line on the edge of town as opposed to the middle of town. An upzoning by the council, really ambitious by then, a great idea, but we saw 1,000 square metre or quarter acre blocks go from being zoned R20 up to 60s and 80s, and unfortunately investors got really involved in that market and drove prices up, and then those developments actually weren't very viable. They had a lot of design issues in terms of making them feasible. And it's interesting that this time around, in terms of this market, it's probably again the first place that we can see where, to use your terminology, the rug's being pulled in terms of a significant change to the market and a potential correction. Now, I just want to emphasise that we're not seeing wholesale values going backwards here. What we're seeing is demand change. So we had East Coast investors involved in that market, the same way we described that they were involved in that southeast corridor around Armadale. And overnight, just before Christmas and then into the new year, we saw those East Coast buyer agents decide that the values had probably got a little bit too high in Mandurah. They weren't that confident about the fact that they would get capital growth into the future.
It was being sold as a Gold Coast.
Yeah.
And we know it isn't the Gold Coast.
So again, it was actually sold in the wrong light yet again, when it really is a market that is a home to retirees, doesn't have a very good local economy, i.e. doesn't have an industry that underpins the local market. And to probably jump on a point that you like it, we hit the affordability ceiling in that location. So the locals can only afford to buy a property worth X dollars, and in this case it seems to have been the range of $550,000 to $600,000, and that's where the...
You're saying it's happening again in Mandurah, but not to the same extent.
It's not a correction in prices at this point in time. It's a ceiling in prices where locals can only afford, with disposable income in that location, to buy a house that's about $550,000 to $600,000. So as soon as we started to break out of that price zone, the buyer agents left. So heard examples of 23 potential buyers at a home open pre-Christmas down to 5 post-Christmas. Same property, no reason for it to have dropped significantly other than buyer agents out of the marketplace. And therefore what we've seen is the values of property, instead of breaking through that $600,000 mark, they've actually settled into the $550,000 to $600,000 mark.
Okay, so 2 points I would make. One, why wouldn't that be similar to your end of the train line in Armadale and your Quinanas to the space as well?
Yep.
Secondly, as a counterpoint to that, as interest rates start to drop, does that not solve that problem, or at least soften that, make a softer landing in that situation?
So that's why we're really confident that values won't go backwards in these locations, and I'm talking about Greenfields, Meadow Springs and Mandurah itself. We expect that there will still be local buyers there. It's still in their affordable range. If interest rates go down, it probably makes it slightly more affordable for them. The reason I called out Mandurah is this is where we can actually see those examples of the price ceiling coming in. We expected, when we went looking, to find this case in Armadale, and we actually can't find it at the moment.
That's
so
interesting.
that there is a bit of a price ceiling, but the values aren't correcting downwards into a new price zone, i.e. when they try and get $550,000 to $600,000 in Armadale, they're still achieving those values.
Do you think that's because Armadale offers a different amenity or has a different ownership profile?
Yeah, I think it's probably the employment factor. There are actually a fair number of local economy impacts around Armadale, whether you go back up into Canning Vale and the huge amount of employment opportunities there, or in fact into the industrial area of Armadale. There's a large amount of small and medium enterprises in there.
Yep.
And then you get into Forestdale in terms of the huge tracts of industrial land that have been created through there. So I think it is actually employment opportunity through there. Yep.
Interesting. It's been a really great chat, Brendon, talking about what's happening in this volatile world that we have landed ourselves in the last, well, feels like 6 weeks really, that it started to become noisy, but not as scary, I think, for Perth people who are talking about property, looking at property, and therefore, as always, a steady head is what is advised in this market. Don't go selling because Donald Trump's just annoyed Keir Starmer. There's a lot more going on in the Perth market that is totally irrelevant to a lot of that. But more importantly, the fundamentals of demand and supply, really the update there hasn't changed.
Yep, absolutely. And people might be cautious for the next month or so. And in particular, we've got Easter that will interrupt our market activity. But we expect that our predictions earlier in the year of steady growth in values across most Perth suburbs to hold true for the rest of the year.
Mate, my pick, April will be a sideways month because of the noise.
Yeah.
And the second we start to see those interest rates drop, possibly even 50 basis points in May, then we'll probably go in to see most of this year's growth from May onwards, I would suggest.
Yeah.
Thanks, mate.
Cheers, Trent. Thanks, mate.
Thank you for listening to another episode of the Perth Property Show. If you've only just joined the conversation, you can catch up by heading over to our website, perthpropertyshow.com.au, subscribing to the podcast, or joining our Facebook page. Don't forget to tune in next Monday at 7 a.m. for more expert insights, local analysis, and suburb spotlights. Happy hunting!